So basically what will happen is you will do this assignment and submit it to me before Saturday. So once you have submitted the assignment, that will become one big part of the evaluation. Then on next Saturday, you can present the, whatever you have done in the assignment, you can present that to the class. This is what I found, this was the problem, this is what I found. And you should not worry about what I will ask, because it will basically be something which we have discussed in detail. So it will not be too much of a problem. That's one. And apart from that, what we will do is, we will also have a one-on-one interview in which I will be asking you questions about from the course, from different units in the course, to evaluate how well you have actually understood the course. And on the basis of that, I can then say that you have done well, very well, etc. And then I can send the marks or the grades to Neeraj ji, and on that basis he can give you people a certificate. That is the plan which we have in mind. So it's necessary that today's class was necessary mainly because I am going to do a revision of the course. That is number one. And number two, to give you this message that I will be okay. Good evening, Praveen. I just saw your message. Yes, you can remain on mute. Just for your information also, I will be sending you an assignment this evening or maybe tomorrow morning. So you will do the assignment and submit it to me. You can use your free time. It will take you 2-3 days. Easily you can do it. And don't put yourself under any pressure. Just work about a little bit each day. You'll finish the assignment, submit it to me. And then when we meet again on Saturday, on that day, you should be prepared with, your, like the go through the entire course. Go through the course and be prepared to answer questions on the content of the course. So that is two. And the other thing is that whatever you do in the assignment, you will present that on Saturday next. So Saturday and Sunday I have basically kept free for this only, so that we can not do anything new, but do this. In case we finish this early, in case, like we manage to, you people make your presentations and we still have time, then it will be an open session. We can discuss anything you want to discuss, or we can continue with revision. So you, on any part of the course which you want me to, so I can do those things. So Shruti, any idea about Tanya?
No, sir, I can call her and check.
Just call, because I had told her last time that she should be here today, and Alice and Tanya, if they can also join, it will be very good. She won't come?
No, sir.
Okay. Then in that case, I think we will just start with the revision. And here, see, I would like you people to participate so that I understand about how well you have basically understood this whole thing. So let's go to our first unit. When we started the course way back in at the end of November, I think it was 27th of November that we started. 27th or 28th, something like this. And at that time, we were starting with these things. So what is financial management? So we said that it's basically covers investment, capital structure, dividend policy, and working capital management. Now, over the last almost 4 months, we have been speaking about many of these aspects. Apart from this, of course, we have also looked at financial planning, mutual funds, equities, insurance. That aspect also we combined with this. But this is something we have been emphasizing a lot. In the last few weeks, we have been doing a lot of work on this working capital management, the ratio analysis and things like that. So I am just assuming that that part of the course is still fresh in your mind. What we did in the last, let's say, 1 month, where we were focusing on financial accounting analysis, that part. What may have slipped from your mind by now will be these earlier things. So what I'm hoping to do is we start with this part. And so here is the presentation. So capital structure and cost of capital. So now what I want to do is, please try to, answer the question. Whatever is here, if you can tell me something without me showing it to you, that will be better. Instead of me just going through it, in which case it will be very boring. For example, if I say capital structure, what comes to mind? Any of you, please answer. For today's session, let's make it as interactive as possible. So capital structure is what?
It refers to the proportion of equity and debt in the capital of the company.
Okay, good. Paresh ji, anything to add there?
No, sir, same.
Same. Praveen ji, he's on mute. Okay, fine. So proportion of equity and debt, fine. Remember, equity and debt are the only two ways of getting capital. So your source of funds are equity or debt. So either somebody has to buy a share in your company or somebody has to lend money to. That's the only way you will be able to get money. And these are your liabilities. Basic point is, these are your liabilities because you are responsible for paying them back. So for example, the persons who have bought shares in your company, you are responsible for giving them dividends and later on, maybe increasing the value of their investment. Those who have given you debt, you are responsible for paying them back. Now, what should be the proportion of equity and debt? This is something which is going to be decided by the board of directors. Different companies may have different approaches to this. So different companies can have different approaches to how much equity they want and how much debt they want. See, recently I was showing you those figures from Colgate Palmolive India Limited, remember, CPIL, all the ratio analysis that we had done in the last few weeks, that was basically based on the Colgate figures. Now, if you look at Colgate, you will find that it is not even 80-20. It is probably 95-5. They have preferred to keep everything in equity. Debt is very, very low. This is an individual decision. What
Sir,
you want?
I have one question. Companies which are not listed to share market, does that mean that 100% debt or 100% their own money?
No. See, the only difference between a company that is listed on the share market and one which is not listed, that means it's a private company, is that in the case of the listed company, they are getting capital by way of shares. They issue shares, they get capital from the public at large. everyone is in a position to buy a share. But in the case of a private limited company, the capital is actually contributed only by the persons who are members of the company, the promoters and their closed group. So they are not publicly approaching people for funds, but there is no, what shall I say, there is no restriction on them approaching people privately for funds up to a given number. I think the total number which they can probably approach is about 50. So they can get funds like that, the capital part. As far as the debt is concerned, whether you are a private company, whether you are a public company, you are free to approach a bank for debt. So there is nothing, the debt part is not related to whether you are a listed company or you're an unlisted company. The debt part is basically related to just one thing. Is your business model good enough to give you revenue so that when you go to the bank and ask them for a loan, they say, yes, we have faith in your business model, so we will give you a loan. You understand, Pareshji?
Yes, sir, got it.
Now, so here I had given you some simple examples where I said that if you take, let's say, a 1 crore loan from a banker, it is obviously a debt. And if he asks for 12%, it's a fixed cost. So the cost of debt is 12%. If you take from equity shares, what is the return the shareholder will expect? He will basically expect something more because his risk is more. So he will generally expect something more. And how much more will he expect depends on what opportunities are available to him in the market at the same level of risk. So if a shareholder gives you money, he is not going to be happy if you give him a 12% return. He will want much, much more than that, because if you wanted a 12% return, he would have tried to go for, maybe a mutual fund, something less risky, something where at least his capital will be protected. But what is the other risk that the shareholder has when he gives money to you? Maybe you don't give him dividends at all. He is facing a very real risk. If your company collapses, he loses his capital also. So there are a number of risks which he is facing. So mostly people feel that if you really want to run a company on a long-term basis, you should at least manage to give something like a 20% return. Okay. So you already know this. If the cost of debt is 12% and the cost of equity is 20, what is the cost of capital? You can average it out. How much debt have they taken? How much equity do they have? And find out exactly what is the amount that they have. So I had given you these examples where we said that, showing you how interest which is paid on debt is a tax deductible expense. So if the profit before interest and tax is 500, and if a company has more debt, 240, company A has a debt of 120, company B has a debt of 240, then in that case, this company gets a relief on taxes up to 240, because they will be paying taxes only on the actual profit after interest, which is 260. And this company will be paying taxes on a larger amount, mainly because the interest amount is less. So one big advantage of having debt is that the interest is a tax deductible expense. This was another thing that we discussed. This is something which I'm showing you again, mainly because during the course of our lectures, I found that time to time, there would be mistakes in understanding the structure of the balance sheet. So remember, sources of funds, capital, long-term borrowings, this is the debt part. So these are the two main sources of long-term capital that the company has. Current liabilities are obviously those items which have to be repaid within 1 year. Now, if the company begins like this, every year, as it begins to earn more and more profit, that is added to the capital and appears as reserves and surplus. So you can say that profit is an internal source of capital. This is one thing to remember. The assets, of course, are very simple. You have these assets, these fixed assets and land and buildings. These are essentially the assets which the company is not selling. See, it's not interested in selling these assets. What it is interested in is using these assets to generate revenue and earn from the sales of the goods that it produces. So basically, these assets will help to produce the goods. The goods will be sold and the company will make a profit from that. So this is the reason why this part, these are basically referred to as capital goods. This part. Then you have the current assets. Obviously, when the company gets into business, whatever model it has, it will need cash, inventory, receivable. There will be tax fund receivable. All these things are going to be there. And essentially, this is the structure of the balance sheet. So whenever you feel that you are getting confused about the way the companies actually function, what you should do is refer back to any balance sheet and have a look at the way the items are placed there. So that is one important thing here. Then we come to the profit and loss account. So remember, in this case, the source of revenue for you is sales. One big thing here. If you take out the cost of goods sold, that is the actual cost of the goods sold without taking into consideration the operating expenses. If you take this part out, you will get your gross profit. And then from the gross profit, you will basically take out the operating expenses to get your operating profit. So these are the normal heads for operating expenses: rent, power, the salaries which you're paying your employees, the marketing expenses. Depending on the type of company that you're running, the proportion of these expenses will change. So for example, Colgate Palmolive India, when we were looking at, for them, this is the big expense, the marketing expense, because for an FMCG company, it is necessary for them to continually remind their prospective customers that we are here, these are the goods we produce, it's very good for you in one way or the other, so buy our goods. And we have all this. In this entire lot, which is the one which does not create an outflow? Which is the one item here which does not lead to an outflow of cash?
Depreciation.
Depreciation. So you need to remember that the depreciation part here is a book entry. This is something which you are doing only for the purpose of recording the fact that your assets are contributing something. So what is the value that they are contributing to the business, to the whole, to the cost of goods, to, you can say, the operating expenses? That is 5,000. And then you get your operating income. It's possible that the company has made investments in in some assets, in some other assets. It could be an investment in a allied concern. It could be an asset in anything at all, something other than the company. And whatever income it gets from that is coming in the non-operating income. Let's say the company has some buildings in its name, and those buildings are rented out to someone. It is getting a rental income. Even that is going to be shown as interest on investments. It will come here. So the total non-operating income is there. And then when you add the operating and non-operating income, you get the actual income of the company. So that was one part. We gave you this example here, remember, of a standard balance sheet. this particular balance sheet was of NTPC, where you see the same structure is there, equity. So this is the amount of share capital. This in big figure here is basically the amount of profits that they have earned over the years. So the total shareholders fund is this 1,18,000 crores. So this is a big company. So you can see this. The long-term borrowings, as you can see in this case, are even more than this. So it's 1,51,000. These are the long-term borrowings. And this sort of, so when I see this, when I look at all these things, I should be very clear that all companies, their, what shall I say, their balance sheets will always be this one. Okay. So the next part was, what is a dividend? So we did this. So dividend was basically the cash payout made by a company from its profits to its investors, right? See, the other thing to remember here is that a dividend can only be paid from profit. So the proportion of profit that is to be distributed is to be decided by the management of the company. So in this context, I have one question. What actually is why do some companies, let's say, give more dividend and some companies give less dividend? Or why does the same company give more dividend in 1 year and less dividend in another? Did you get my question, Paresh ji and Shruti? So the dividends of companies tend to vary from year to year. So my question to you is, what is the reason behind this?
So it's only depend on profit of that year?
It depends on the profit of the company. Now,
Yeah.
Think of it like this. Why does the percentage change? Let's say that a company makes 2,000 crores of profit. So let's say it is making roughly 2,000 crores every year. If you look at the profits of companies, you will find that there's not a very large difference in the profit from year to year. So 10%, 20% variation will be there. So let's say a company makes 2,000 crores in 1 year, makes 2,200 crores in the next year. Then in 1 year, it decides to give 10% dividend. In the next year, it decides to give 20% dividend. Something like this. Why is there this difference?
Sir, maybe they want to invest money for the expansion in that particular year. So maybe they're going to give less dividend that year.
Okay, very good, Paresh. So when they want to invest money in the development of their own company, increase their asset base. So basically what they are doing is they are giving you less return today in form of dividend, but they are investing money in their company, hoping that the profits will increase even more tomorrow. So tomorrow they can give you not just the money that they did not give you this time, but much, much more than that, because the base is bigger. The total assets are now bigger. So that's one. Is dividend relevant? So, there are different theories here. One theory says that dividend is irrelevant because they have the option of selling the shares in the market to generate cash if they need funds. So market behavior shows that dividend payouts minimally affect share price. This is one theory. And but remember one thing. Dividend is maybe for the smaller shareholders, dividend may not be so important. But the bigger shareholders in the company, the people who actually started the company, who even today have the largest shareholdings in the company, these people are the management, the promoters. For them, dividend is very, very relevant because that is the biggest incentive they have for doing the business. So the dividend policy of the company has to take care of not just the shareholders, but they will also have to think about the promoters. So the dividend is definitely a relevant part. Most companies view a dividend policy as an integral part of their corporate strategy, and the management has to decide that dividend amount. So these are some of the thoughts that are there around dividend. I had given you 4 or 5 different types of dividend policies. One of them was this, the constant dividend policy. So, a constant dividend policy will generally happen where the company is, let's say, mature. Its revenues are stable, its investments are in place. Let's say a company like Colgate-Palmolive, for example, it's okay in giving a constant dividend because it is earning at a very steady rate, and it has a very high return on equity as it is. You may not remember the figures, but I'll just remind you that in the case of Colgate-Palmolive, the return on equity was more than 100% for all those years which we were studying. This was between 2012 and 10, 11, 12. They were actually having a return on equity of more than 100%. So for a company like this, it is easy for them to give a constant dividend. Shareholders are also happy. And but companies which are expanding, companies which have to continue to make investments in their business, for them it will not be possible to have this sort of a policy. It will depend, of course, on the sort of capital expenditure that they require to put in. Those companies are likely to have a residual dividend policy. So residual dividend policy means first I look after all the different types of expenditure that I have. I look after everything. And once I have taken care of that expenditure, it is only after that that I will pay dividend. So it's residual. It comes at the end. First I have done everything and then I will pay. So the company pays out dividends. Whatever remains after the company has paid for capital expenditure and working capital. So capital expenditure is obviously these are long-term investments made in the company to increase its revenue earning capacity. And the working capital obviously is as you increase the size of the business, you will need more working capital. So let's say you increase the productive capacity, you are going to require much more raw material. You may need more staff. Maybe your marketing effort will have to increase. So you will need more of the current asset side. And so for that, you will require to have a larger contribution from your long-term sources. If you recall the discussions around working capital, you will see that. Okay. So the two things which a management can approach, the way they approach their what is their purpose in running the company. So one long-term approach can be wealth maximization. So what I do is all my policies are basically based on increasing the value of the company, which will be reflected in the long term in the share price of the company. So basically what will happen here is that as I begin to invest more and more in the company, let's say I invest in research. You take the example of a pharma company which decides to, not focus on short-term profits, but look at the long term and do a lot of, let's say, investment in their R&D department, let's say to enable the production of, let's say, a special type of antibiotic for, let's say, COVID. Let's say they do this. Now, obviously, if they are going to invest a lot of their profits in this, then the dividends may not be available immediately. Maybe even the profits will not be there. So what will happen is, in this company, the shareholders and the promoters will have to be satisfied with waiting for something big. Now, if this company is successful and can come out with a drug which is very effective, then they will be able to charge high prices for that drug, very high prices for the drug. And this is what most of the pharma companies, the good pharma companies in the world, that is what they do. Invest in R&D. When they manage to come out with a drug, that drug is then sold across the world at very high prices. And as a result of that, what happens is that the overall wealth of the company increases. So that can be one policy. The other policy can be that I do not make any investments in the future. I focus entirely on showing a good profit today. So you want to show a good profit today, then obviously you are going to sacrifice some opportunities that are available for you right now to do better in the future. So these are the two different types of approaches the management can take. So this was another thing that we had discussed. Then we had also discussed the concept of the American depository receipt. So we, in the context at that, when we were discussing this was that there are different ways of raising capital. So one way was that we raise capital by selling shares in the Indian market. The other was that let us sell shares in a foreign market. So we expand our horizon, go beyond the country, approach people with money outside the country. So to do that, I have to work through in the case of American deposit receipt, I will have to work through an American bank. In the case of let's say bank GDR, a global depository receipts, that means where I'm trying to get money from a country other than America, I will be working with maybe a European bank. Any bank which is for whom my target area, that is its home base. So let's say that a company decides to raise euro 10 million from investors in Germany. So the company will issue shares to a bank in Germany, which acts as an intermediary for the GDR. The German bank will issue the global depository receipt in the company's name. The German bank will basically make sure that it complies with all the rules and regulations, and they will manage to do it like that. The German investors will buy the global depository receipts issued by the German bank on your behalf, and each GDR will have a certain value in the number of shares of your company. So what happens is that the German investor, because he is dealing with a German bank, he has more confidence in the entire issue and he is willing to invest. That was the concept of the GDR. If I'm doing this in America, the same thing, just replace German bank with American bank. And we gave you examples of companies in India which have used GDRs and ADRs to raise funds, Reliance, Dr. Reddy's Laboratories, etc. And if you go back to that particular, the complete presentation that you have, you will find that I had given you examples of the prices of GDRs at that point of time, of these different companies. So the whole, when talking about capital, you should know that there are ways of selling your shares to a foreign investor also. Only difference is that when you do it with a foreign investor, you cannot sell directly. You will have to sell it through an intermediary who is sitting between you and the investor community in that country. So this was there. And the other part here was that these in the dividend payments, let's say everything else will be done through the German company, the German bank, and the German bank will earn a profit on that. So this was a very short summary of that first unit. Now in the second unit, we spoke about the concept of the time value of money. Now, when we spoke about this, the time value of money, we basically said that the value of money changes with time. It is affected by two factors. What are those two factors? Anyone? What are those two factors? Because of which there is
inflation and interest rate.
One was interest rate and the other was?
Inflation.
Inflation. Very good, Pareshji. So these are the two factors that are there, because if the money is given to you today itself, you can invest that money and you can get some interest on it. And inflation reduces the purchasing power of money. So for example, you may have noticed that the rupee is depreciating. Why is it depreciating? Because the purchasing power of the rupee has gone down. Therefore, the exchange value of the rupee vis-a-vis other currencies, like let's say the dollar, is going against the rupee. Now you need more rupees to buy a dollar. So that reflects the purchasing power. So as time passes with inflation, the value of money can go down. And even if inflation is constant, the value of money can also go down because of the loss of opportunity to get interest from the money that is there. The basic principle is a rupee today is more than a rupee received in future. This was one. So this is one part here. I had tried to explain this in this way, where we said that the purpose of showing it to you like this was not so much to explain anything, but just to tell you that the calculation is done by reducing the percentage to a decimal and multiplying that with the principal to get this figure here. So the calculation is 100 into 1.10. What you should always remember is that when I multiply, I will also add a 1 to the amount of interest. Because if you don't add 1, what will happen is you will only be left with the interest amount. The principal is not reflected. So the 1 in all these calculations basically reflects or represents the principal amount. In this case, the principal amount is 100. So it means 100 into 100 plus 100 into 0.10. If the principal amount was 2,000, then it would have represented 2,000. Then we said that the concept of discounting is there. Rupees 100 receivable on 31/12/21. Remember, this particular class was taken before December 21. So I had taken this. So interest rate or discount rate is 0.10. The value on 1/21 is 100. Calculation is 110 divided by 1.10. So what we were doing here is, we are saying that the value on 1/1/21 of rupees 100 so you can see it like this, rupees 100 on 1/1/21. What is the future value after 1 year? It is going to become 110. 110 rupees, which is going to be received 1 year from today. What is the present value? It is 100. Okay, so this was one simple thing there. Then I had also explained to you this idea about doing this same calculation in Excel, where you use this particular. So you open an Excel sheet, you put these figures there. In the FV, in this basically cell, let's say C4, if you put this formula equals to FV, open brackets, these will appear. So you just select each of these, the rate, the number of periods, the present value. If you select this, click the button, you will get this formula. So remember, this can be used for any compounding problem. The interest rate is to be written not like this, but as 0.15. If you remember in Excel, if you write 0.15 and then click on the percentage icon on top, it will show the, just for purposes of viewing, it will appear like this, 15%. But actually, as far as the formula is concerned, it will take it like this. So if you're doing this formula manually, you would have to use 0.15. The other thing to remember is that present value has to be written with a negative sign, this one. So this refers to the annuity for each period which is equal. As this does not apply in this case, it is to be shown as 0. Type indicates the type of cash flow. So if you put this amount in the bank, 55,650 in a bank at 15% for 3 years, this is compounded quarterly. The future value can be calculated by considering the number of compounding periods in a year. If there are 4 periods in the year, the number of years, the number of compounding periods will be 12. So you will reduce the interest proportionately. That is the basic thing to remember out here. So if my interest is 15, there are 4 compounding periods coming in. So I am going to divide by 4 so that in place of 15%, I can write 3.75. And in the number of periods, I can increase this to 40, like that. Then that you will get the right answer there. I had also shown you this, the present value of an annuity. So an investor may invest a lump sum and receive a constant periodic sum of money every year for a certain number of years. You invest something, let's say, in a scheme which is paying you a fixed amount on an annual basis. This is your annuity. So if you're, let's say, investing 100 rupees and you're getting a 10% annuity, that means you're going to get rupees 10 on a yearly basis. Now, to find out the present value of the annuity, we will have to find out the present value of the sum received each year. Remember, the money that you will receive in total, those cash flows are going to come to you in the coming years. The first cash flow will be 1 year from today, the second will be 2 years from today, etc. So the present value of each of the cash flows will be different. So if I want to find out the present value of the total, what I have to do is I use this particular. So period 1, what is the present value of the cash flow that I'm getting? If whatever 1 is represents whatever is the value. If it is 10, you will write 10 here divided by 1.10. This is the discount rate. If the second period, I will square this 1.10 squared, third period 1.10 to the power 3, fourth period 1.10 to the power 4. If I take this, these 4 years, and I say that my annuity for each year is rupees 10, in 4 years, I will receive 40 rupees. What is the actual value of these 40 rupees today? It is 31.84. So this is how you calculate this. Suppose an investor is to receive 1,000 in year 1, 1,500 in year 2, 1,700 in year 3, 800 in year 4. The required rate of return is 10%. What is the present value of these cash flows? So you will basically use this principle. In the place of 1, you will put the actual value. 1,000 here, 1,500 here, 1,700 in the third period, 800 in the fourth period. You do all that, and you will end up with the exact cash flow of the present value of the total cash flows that you will receive. Then we also spoke about the concept of a perpetuity. So a perpetuity is basically an annuity which you receive for an indefinite period of time. For example, banks sometimes come out with these perpetual bonds. So investors who put their money in those bonds, they are entitled to receive an annuity for as long as the bank continues to exist. They will continue to receive the annuity. So irredeemable preference share or a preference share without maturity. You know, if this is actually given, note the word irredeemable. What does irredeemable mean? Anyone?
You cannot sell that share? Or
The company cannot buy the share whenever it wants.
The company, once again, Shruti?
The company cannot buy back that share after paying whenever it wants.
The company cannot buy back the share. The point is that once the company has issued the share, that share will be there till the company exists. It cannot be redeemed. So, if you want to sell that share, you will have to sell it to another investor. There will be no dealing with the company. So basically, what I was telling you was, if you just take, if an investor expects to receive 1,000 annually from his investment, the present value of all the cash flows that he will receive till infinity is basically 1,000 divided by 0.10, if that is the rate of interest at which he is going to be given that. So you know that it is 10,000. So it's a very handy formula in the case of a perpetuity. Then we spoke about the concept of a nominal interest rate and the real interest rate. So the nominal interest rate is the interest rate which appears in front of you. You know, the bank, let's say, says that our rate for FDs is 5.75%. So if you keep money with them for 1 year, they will pay you an interest of 5.75%. This basically is a nominal interest rate. This is the nominal. What is the real one? The real one will be basically the same thing discounted for inflation. That means, if, let's say, in this particular case, if you go to a bank and the manager informs you the rate of interest is 5.5%, and then the retail inflation is 4.48, essentially what are you going to get? You are going to get a real return of 1.02%. That is why if inflation rises, the interest rate will also rise. Because otherwise, if you don't raise the rate of interest, then people will get a lower real rate of return. So this was the concept of nominal and real. This was basically the first 2 units. Then we come to this cost of capital, where we spoke about evaluating different investment decisions. So the first thing to note here is that whenever an investment is being made, investment in a company, in let's say in an actual industrial unit, the first thing which you have to consider is what will be the cost of capital. So even if you are not taking debt, even then it is necessary to know what the cost is. If you are not taking debt, if you are, let's say, putting the entire money up on your own, what will be the cost? Will it be 0? So let's say, Pareshji, you are setting up a company and you are going to put in entirely your own money. It takes 10 crores to do this. You are putting your own money, 10 crores. So this is the capital of the company, the 10 crores that you have put up. What is the cost of this? Anyone? Shruti?
Sir, could you please repeat the question?
See, my question is, let's say that Paresh Ji is investing in a company and they need 10 crores to start the company, and he puts up the entire money. So the entire 10 crores, Paresh Ji and his family members, they do this, they start a private limited company. The entire money is put up personally by them. What is the cost of capital for them?
Not getting your question right.
Yes, Paresh?
I'm not getting your question actually.
My question is,
I understand your question, but maybe I can't answer.
The part of profit they'll take back from the company?
No, but suppose I ask you to tell me what percent is the cost. What will you say?
100%?
No,
No.
100% is not the cost. See, you're missing one thing. Suppose you did not invest 10 crores in the company, Paresh, and you invested it somewhere else. So since you invested 10 crores in the company, the assumption is that you had 10 crores with you. Now, this 10 crores that you had with you, if you did not invest in the company, you would have invested this somewhere else. When you invested it somewhere else, what you would have got some return. No? So if you don't invest there and you take that 10 crores and you invest in the company, then what will be your cost? All of you are forgetting this. No? This was opportunity cost.
Yes, sir. Yes, sir.
Paresh ji, clear?
Yes, yes.
थोड़ा घुमा के पूछे थे. That's all. So basically, the cost for the promoter of the company is the loss of opportunity. Anyway, coming to this, let's say that you have a project that has a cost of capital of 14%. If I want to make this investment, I have to be sure that the company will give me a return of more than 14%. The profits that I earn, the return on equity that I get, has to be more than 14%. If I'm not getting that, then there is no sense in investing in the company. So the return on equity has to be more than the cost of capital. Otherwise, there is no point in going ahead with the investment. And how do I calculate what is the amount of return I will get from the company? So the two methods that we have are the NPV, net present value method, and the internal rate of return method. So if I am through these methods, if I am able to understand whether my return in the days to come is going to be more than my cost of capital, then I can decide to go ahead with the decision. This is why the cost of capital is very important for taking that decision, whether to invest or not to invest. The other thing is that it will also help you to take a decision about debt. So you know that debt is a tax deductible expense, and interest cost reduces the overall cost of capital. So if I know my cost of capital, I know my cost of debt, I am able to understand my overall cost better. And once I know that, it makes it easier for me to take a decision on whether to invest or not. It will also help me to take a decision with regard to my capital structure. Should I invest more? Should I invest less of my own money? Should I borrow more, borrow less? That part you will have to think about. And finally, this whole cost thing, it will help you to evaluate the management itself. Okay, how well is the management of my company performing? Because if they are performing in a way in which they are getting a return on equity which is less than the cost of capital, then obviously they are not performing very well. So this is something to remember. The other thing which a few classes back, Shruti was asking me this. So this was the point here, return on total funds invested, capital plus debt, by the firm should be higher than the cost of capital. So this was here. If the firm is earning more than the cost of funds, it will create wealth for its shareholders. If you are earning less, then what is happening is the profits of your company will basically be going to pay the financiers. So it will erode your capital. That is one important thing here. And now we come to the question which you people are missing right now, opportunity cost. Simplest example here, you have the option to invest in postal certificates with a 3-year maturity at 7%. And you have the option to invest in fixed deposits with a 3-year maturity at 6.5%. Risk is equal. If you decide to invest in fixed deposits at 6.5%, maybe because you have greater liquidity in fixed deposits, your opportunity cost is 7%. Because the other opportunity which you sort of did not take, let's say, the benefit of, that would have given you 7%. So this is the rate of interest the investor has foregone or given up to make the investment in fixed deposits. So the same question, that same logic applies in the case of investing in a company. If you had not invested in the company and you had decided to invest, let's say, in these postal certificates, then your opportunity cost would have been 7%. One thing to remember always is that when we decide this opportunity cost, it should be always, taking investments with comparable risk. So you should not actually compare in the way I just compared and said that comparing, let's say, an investment in the company with investments in postal certificates, because the levels of risk are entirely different. So if the risk is more, you will expect a higher level of compensation also. So if there is some other investment which has the same amount of risk as investing in your own company, what is the amount that will give you? Let's say you invest in a friend's company. Levels of risk are now same. Instead of my own company, I'll put my money in my friend's company. What is the amount he is willing to pay? Like that. Okay, then we also looked at this concept here. So the general formula for the opportunity cost of capital, the required rates of return for investor are market determined, remember. So the opportunity cost of capital is given by the following formula. So the investment amount in year 0. C is the return expected by the investor. These are the cash outflows for the company for year 1, year 2, etc. K is the required rate of return on the cost of capital. So if you basically discount all the cash flows which the investor will receive, and you find out that will give you the opportunity cost of capital. Cost of debt. For cost of debt, of course, is the contractual rate of interest. Whatever is the rate of interest which has been promised to you for debt, that is the contractual rate. So if the company takes a loan from a bank at 12%, cost is 12%. If the company issues bonds to investors at 8%, then the cost is 8%. Remember this word coupon over here. So the rate of interest on a bond is referred to as a coupon. So remember that. So suppose a company issues a 3-year bond at rupees 100 at 15%. Then the present value of the outflows discounted at 15% will be equal to rupees 100. That is the face value of the bond. So I've given you this simple example where I said that if for a 3-year bond is issued by a company, and then the company is saying that the rate of interest or the coupon on the bond is 15%. If I take the 15%, the 15 rupees I will get each year. If I discount them by the rate of interest, 0.15. So 1.15, 1.15 squared, and 1.15 to the power 3. If I take these, and after 3 years, I will also get back my original investment. If you take these and you add this up, you will get exactly rupees 100. This is the point which I was making that day. The present value of the cash flows will be equal to the discounted value of all the amounts which you receive in those 3 years. So the face value of the bond actually reflects this. So normally, it's, if you're approaching this for the first time, it is hard to believe that this calculation will give you the same figure you started. But basically what it is telling you is that what you are paying today is the present value of the amount that you will receive in future. So when you are receiving these 15 rupees every year, its present value today is 100. Therefore, you are there, the company is charging you 100 rupees. So the present value calculations using discounting, they help you to understand the entire mechanism of interest better. That was the point in this. And so we are using the concept of annuities to make this calculation. Each of the outflows is treated as an annuity. Now, we also looked at another aspect. Sometimes a bond can be issued at a discount. That means lower than its face value, or it can be issued at a premium, depending on the market position. If it is issued exactly at face value, then the market price is, then it is said to be at par. So this is one. When a bond is issued to investors below its face value, it is said to be issued at a discount. So a company issues a 15% 7-year bond below its face value. So the face value is 100. The company is issuing the bond at 94. That means it is encouraging investors to buy something which has a value of 100, but it is asking them to pay only 94 rupees. So that is, they're giving it at a discount. So when we go to to buy something from a shop, and we ask them what is the discount. So this is just like that. That word discount there is derived from this concept out here. So instead of 100, they are charging you less to make the bond more attractive for you. The rate of interest is 15%, they are saying. But what they're basically saying is that you give us 94, we will give you a 15% return on 100 rupees. So this does not change the coupon rate of the bond. The investor will still receive rupees 15 per annum. Now, what is the actual yield that the investor will get on this bond? So what will happen is the cash outflows for the company will be rupees 15 for 7 years, and it will redeem the bond by paying back rupees 100 at the end of the 7th year. The investor has paid less than the face value, but is still getting rupees 15 per year. So on a face value of rupees 100, this was 1500. So for 94, the effective rate of interest is higher than 15%. This is the point which you have to remember. You are getting, had you paid 100, you would have got 15. Now for 94 rupees only, you are getting 15. So you're getting something more. What is this telling you? That if the price of the bond is reduced, then in that case, the yield of the bond will go up. So we can calculate.
Sir, can we have a 5 minutes break?
Okay, fine.
We continue.
Shruti, Paresh ji,
Yes, sir. We can start.
we can start. Shruti, you're here?
Yes, sir.
Okay, so basically, we have tried to do the same calculation out here. But the problem is that what is the actual interest rate that is being paid? So we are trying to find out the present value of each cash flow from year 1 to 7. There are yearly payments at 15%, and in the final 7th year, the bond is redeemed at rupees 100, is paid back. Now, we can do this in Excel. If you do this in Excel, and because if you try to do it manually, it is difficult to predict what this rate is going to be. Because you will have to do it by a trial and error method. You know that it is higher. So if it is not 15, is it 16? If it is not 16, is it 16.5? If 16.5 is too low, what is the exact rate? So if you do this calculation in Excel, it will tell you that the yield of the bond is basically 16.5. How have you done this? You invested 94 rupees. And in year 1, you received from year 1 through year 6, you received through 7, you received 15 rupees. In year 7, you also received the 100 rupees, which was the face value of the bond. Now, what is the rate of interest that you actually receive? It has to be higher than 15 because you paid less than 100. In Excel, if you do the same formula, if you use that formula, the present value formula, the IRR formula, you will get 16.50. Now, what the IRR is doing is, it is matching all the cash flows with the amount which you actually invested. So, if had you bought it at face value, the actual yield would have also been 15%. So the IRR in that case would have been 15%. But since you bought it at less, therefore, the internal rate of return or the yield of the bond is more than the coupon, is more than 15. And this also tells you one more thing, that if I sell something at a discount, if the price of the bond goes down, the yield goes up. So these two are inversely proportional. That is because of this. You are paying less to get the same amount. So this is the interesting thing here. And you can actually do this in Excel by using the IRR formula. Now you think of it in a different way. Suppose that the company sells this at a premium. That means they are charging more than the face value of the bond. The bond face value was 100. Your bonds are in demand. The company decides to sell it to you for 105. It doesn't mean that it will return 105 to you. It is going to return only 100 to you. And if the rate of interest is 15%, they will give you that 15% return. Now you can use the same formula, the Excel formula, to get that. And when you do that, you will find that the actual return there is 13.84%. So you will find that the yield of the bond has gone down. Why has it gone down? Because when you initially invested in the bond, you paid less than the face value. You paid more than the face value of the bond. You paid more for something which actually cost less. Therefore, your yield went down. So the same thing you're seeing again. If the price goes up, the yield goes down. So these two things work inversely to each other. So that was another important thing here, which we learned. And finally, we came to this point, which I had made a little earlier, is, when, cost of equity capital, is it free of cost? No, it is not free of cost, obviously, because the investor expects a certain return. And what he basically expects is the opportunity cost. He is foregoing some opportunity to make an investment in your company. So the minimum rate of return that he expects is that much, at least the amount which he actually did not invest in. So the sum of the present value of the expected dividends is actually the cost of equity. And here you should also try to remember that there are two things here: internal equity and external equity. So internal equity is another word for the profits that a company earns and retains within the company. So like we said, that the cheapest of, let's say, form of capital is your own profit. That is internal equity. External equity, of course, is the amount which you take from your shareholders who are based outside. So when you raise issues through shares, it is external equity. Now, we did this, two models we did out here. One was the dividend growth model and one was the CAPM. And in both cases, basically, what we did was, I showed you these formulas about how you can use these simple models to calculate the return. Now, the thing is that these are very basic models. But my purpose in doing this for you was to show you that you can use this model to get some sort of idea about what is the cost of equity. So normally the investor expects not just the dividend, but he also expects a capital gain. So the cost of equity takes into account the dividend expected and the expected growth in the dividends. Now, this expected growth in the dividends is actually in one way you can say that this is the capital gains part of the equation. So there are some assumptions that have been made in the model. One, the market price of the share is based on the expected dividends. The dividend grows at a constant rate. So these things may not be true, but it is a starting point to understand how a calculation of the cost of equity can be made. So we said that the cost of equity is equal to the dividend expected divided by the current market price plus the expected growth in dividends. So let's say I wanted to calculate the cost of debt. What will I say? I will say, in place of dividend interest, in place of market price, I will say principal amount, which I borrowed. So let's say if I had borrowed 100 rupees, and then I say that my interest is 10. What do I do normally? 10 divided by 100 multiplied by 100, and I say it is 10%. So that basic formula is being used here again. But to that, I'm adding one more thing. I'm adding the growth expected also. The growth expected here represents the desire of the investor to get something extra, something beyond dividend. Because any investment which you make, you're thinking in terms of making a capital gain also. So in a very simple illustration, if you bought the share for rupees 90, the dividend expected is 450, and the growth you are expecting is 8% per year, it will basically be 450 divided by 90 plus 0.08, which basically gives you 13%. So that is the basic concept here. And see, if you accept this, it also means that if the company wants to retain earnings, if you, let's say, take some part of that of the profit that you have earned and you keep it within the company, and the cost of equity is 13%, then when you put your own money, you retain your own money in the company, the amount of profit or the return that you actually get should be more than 13. It makes sense now. The cost of equity is 13. This is my internal equity, the profits that I earned, I'm putting it into my company. So I should earn at least more than 13. Because if I had taken this money from outside, I would have had to pay my investor at least 13. So this model basically helps you to understand these things a little better. And then here again, we say that if the selling price of the new share is less than the market price, that discount concept is coming in, then the cost of external equity will be higher than the cost of internal equity. Because the investor is buying that particular share at less than its market value. So for example, if a 100 rupees share is sold to investors at 95, then the cost of external equity will be higher. Because what is happening here, he is going to get, so this is our formula. If the expected dividend is 4.75 and the growth is 6%, what is he getting? 4.75 divided by 100, and it works out to 10.75. This is the cost of internal equity, because this is the face value of the market price of the share. But if the share is sold at less than 100, then what will happen? The cost of equity will become 4.75 divided by 95 plus 0.6, it becomes 11%. So basically what is happening is, it is more than the cost of equity, because the value of your share or the market price of your share is less. The investor is buying it for less. This is the same principle that we saw in the case of the bond, where we said that if a person buys the bond at a discount, the yield tends to go up. This is exactly what is happening here. The share has been bought at a lower market price or a discount. Therefore, the cost for the company and the yield for the investor, same thing, two sides of the same coin, it has gone up. So the growth of dividend reflects in the share price in the form of capital appreciation. So as the, let's say the company keeps growing and keeps giving more and more dividends, this is reflected in the share price of the company, and that is what every investor wants. So I've given you this, how do we estimate G? So this is the return on equity multiplied by the, suppose ROE is 16%. If you reinvest the entire profits into the business without giving dividends, you assume the same ROE for the next year, then G will be 16%. But if you retain 50% of the profits of the growth, will be less, as you have retained half the profits. In such a case, G will be 16% into 0.5 or 8%. So basically what this is telling you is that if less money is put into the company, if less amount is retained within the company, then the growth will also be less. Because basically you are investing less in your assets, so you are getting less. If you invest the full amount, you will get a higher rate of growth. If you invest less, you will get a lower rate of growth. So that simple formula is given here. If I'm only investing 50% of my profits in the company, I'm only retaining 50% of my profits. Then if my present return on equity is 16, the growth rate is only going to be half that, 8%. Very simple. I think you should not have any trouble in understanding that. Then we came to the other model. This was CAPM, where we said that in the case of CAPM, what extra factors are getting into this? So the expected return on investment is one. The risk-free rate is another. The market risk premium was another concept here. And the beta of the investment was another concept. What is the risk-free rate? The risk-free rate is basically the rate of interest on government bonds. Now, when you invest in a government bond, you get a very low rate because the risk for you is very low. The government is expected to always repay what it borrows. Therefore, the risk for you is low. Now, when you invest in something other than a government bond, the risk for you is higher. Therefore, you should get something extra. That is the concept of the risk premium. So we said that if the risk-free rate is 5, the market return is 12, the beta is 0.88, the risk premium is 7. So you can see it here, risk-free rate is 5, risk premium is 7, so the market return is 12. That means when you are investing in the company, you are taking a risk. So to compensate you for the risk, you are getting a premium of 7. So your actual rate of the market return is 12. But there is something called a beta here. And this beta is something which adjusts the premium that you get. In this particular case, if I'm assuming a beta of 0.88, I multiply it by the risk premium, I get an adjusted risk premium of 6.16. If I take this 6.16 and I add the risk-free rate to that, I get my actual required rate, which is 11.6. So basically, what are we doing? We are adjusting the market return by the beta of the company. And what is the beta? So we had spent a little bit, a long bit of time, in fact, when we were discussing this, in explaining to you that what the beta is. So basically, beta is capturing the relationship between the company and the market as a whole. So basically, it is just trying to see if the market moves at, let's say, a rate which we call 1, does the company also move at 1? Does it move at lower than 1? Does it move at higher than 1? So if I say that it moves exactly with the market, that means every time the market goes up by 1%, the rate of return of the company will also go up by 1%. If I say that it moves lower, then it's going to be a little less than the market. So those things are considered in the CAPM formula, which you can go back to those slides. You can see how the beta was calculated. We had taken the case of this company, Ashok Paints, and we had done it there. Then we had considered the concept of this weighted average cost of capital. What is the point here? The cost of capital is a function of two things: the cost of equity and the cost of debt. How much weight should I give to the cost of equity depends on how much equity I have. How much weight should I give to the cost of debt depends on how much money I have taken on as debt. So for example, if a company has taken 10 crores of equity at 15% and 5 crores of debt at 7%, what is the simple average cost of funds? It will simply be 15 plus 7 divided by 2, that is 11%. So this is not a weighted average cost. Here I am giving equal weightage to both 15 and 7, even though the amount of money which I have to pay 15% for is much more than the amount of money I have to pay 7% for. So if I want to get the weighted average, I will get the weight of each component of capital. So the weight of equity is 10 out of a total of 15. Remember, I had 10 plus 5, 15 was my total capital. What is the weight of equity? It is 10 by 15 or 0.67. The weight of debt is 5 by 15 or 0.33. Now, if I calculate 15%, what is the weight? 6.67. So I'm getting 10.05. 7% debt. What is the weight? 0.33, 2.30. My weighted average cost will now be 12.35. So it is not 11, it is 12.35 because I have taken a larger amount of capital at a higher cost. The final calculation has to consider the after-tax cost of debt. In this particular case, how do I do it? Cost of debt 1 minus the tax rate. So suppose the tax rate is 40%, cost of debt is 7%, the after-tax cost will be 7 multiplied by 60%, which is 4.2%. So basically, my cost is going down even more because the interest which I pay on my debt is a tax deductible expense. So what is my actual weighted cost of the debt? It is 1.38%. So what is my actual cost? It is 10.05 plus 1.38, which is 11.43. Now we come to the next part here, which is evaluating a project. So remember, the first step before committing funds to a project is to estimate the cash that the project can earn on a year-to-year basis. So for any project evaluation, the entrepreneur will have to make this particular, he'll have to make some assumptions. He will have to estimate how much cash he is going to get on a year-to-year basis. So for example, the costs are very clear. There will be cost of machines, there is going to be cost of infrastructure. From the working capital, there will be these working capital costs, the raw material costs, there will be labor costs, you will get the cost of production. Later on, there are going to be marketing costs. So you will have to calculate your costs, and then you will have to estimate how much revenue you are going to get when you actually sell the goods that you produce. Without that estimate, this entire thing will not work. You need to first make some realistic estimates, discount those estimates, you will get an idea about how much money you are going to get in the future. You can calculate the present value of that money, and you can compare it with how much money you're putting in today. So the good thing about present value is it allows you to compare something which you will be received in the future at today's particular value. So all the methods in finance for evaluating a project require an estimate of the cash flows. This thing which I have written at the end, remember, this is the basic thing. Any project evaluation you want to do, you will have to make an estimate of the cash flows that you are going to get. What are the methods that we discussed? There was the net present value method. What are we doing here? All the future cash flows are discounted to their present value. So at what rate will you discount? This is the opportunity cost. You will do it at that rate. You get the PV of the cash flows, reduce the outflows from that. Whatever is left is the net present value. Now the outflows which happen, that these outflows are money which is going from your side. So this is happening at the beginning of the project. When you invest in the project, that represents an outflow. And then as the project begins to earn money, you begin to get inflows of cash. So essentially what you're doing is you're taking all those inflows, you're discounting that with present value, reducing the original investment. If what you are left with is actually a positive value, if you're getting that, then you know that you are getting back more than the investment that you made. One thing to remember here is that the rate at which you discount has to be realistic. You cannot discount it at a very low rate. You should discount it at the rate. Generally, the cost of capital is taken as the rate. You can also use the internal rate of return concept. So this is the discount rate at which the net present value is zero. That means the value of all the cash inflows that you will get in the future, discounted by the rate which you have decided, at which point the present value of all those cash inflows becomes equal to the amount that you have invested in the project. That amount is your internal rate of return. Whenever you feel that this is complicated, go back to that slide where we did the calculation of the cash flows of a bond, and where we saw that if a company issues a bond at 15% for 3 years, we found that if I add up all the amounts I will receive in those 3 years, 15 in the first year, 15 in the second year, 15 in the third year, plus the 100 rupees which I had invested in the beginning, if I discount all these by the 15%, then I will get again rupees 100. So I began with 100, end with 100. What is the rate which gave me this figure? That is my internal rate of return. So this was basically another way of doing it. And then you have the profitability index, you have the payback method. Read about these things in the slides. Basically, these first two are the more important ones. So I had given you all these examples to show you exactly how the net present value actually works, where I said that if in 5 years, the person had actually invested 10 lakhs, the discounted value or the present value of all the cash flows, which the 3 lakhs which he receives in 5 years is coming to this 11 lakh 37. The NPV is positive. The rate of discount is 10%. This means that he is getting, it is worth investing in this company. This was one. You are going to earn more than your investment. Basically, what is the net present value? If it is a positive figure, it tells you that you're going to get more than your investment. You had invested 10, you are getting 1137, 236. It's more than that. It's profitable. Therefore, it is okay for you to invest. I look again at these examples. I had done it manually out here to give you an idea about how to calculate the net present value. And in this example, over 10 years, the net present value is actually a negative figure. So if it's a negative figure, what does it tell you? You should not make the investment. See, another way of looking at it is that means that the return you are getting is less than 10%. So I was discounting everything. The discount rate was 10%. If I am getting a negative value in here, that means at 10% I discounted. After 10 years, I end up with 921,685 in present value terms. This means I have got something less than 10. This is the thing to be noted out here. So if net present value is positive, accept. If negative, reject. If it is zero, exactly zero, then you can accept. You can accept because at least it is giving you as good as your investment. The formula for calculating net present value in Excel, it was equal to NPV, and you basically do this calculation. It's very simple. Just remember that in year 0, the year in which you are making your investment, that your outflow should be shown with a minus sign. So if you're investing 10 lakhs, show it with a minus sign. This was there. You'll find this evaluation there. What are the limitations? So the basic limitation here is, what are the good things about it? We already know. What are the limitations? It is difficult to estimate the cash flows. And it is difficult to estimate the correct discount rate over a period of time because the opportunity cost can change. So these are the two main issues here. I had also given you these for internal rate of return. So with the formula, it was here. And so I think you had also done these. Remember when we were doing it in class, we had done these with you. Most of you had your laptops with you. You had done it in class along with me. And if you go back to those Excel files that you had made at that point of time, look at this particular slide here, you will recall that whole thing. So that is there. So this was all about the internal rate of return. This was another example where I showed you how this can be done in the manual way. And what we made an evaluation of this. We also did this concept of the profitability index. Basically, all that is done in the profitability index is you are just taking the amount, the present value of all the cash flows that you receive. You are dividing it by the investment that you had made. You are getting a figure if it is positive, just like net present value. The only difference is that it is being reduced to a decimal. The rule remains the same. If it is greater than 1, accept, less than 1, reject. If it is exactly 1, that means it's the same as your IRR, you will basically, you can accept it. It recognizes the time value principle. It is consistent with value maximization. The index can be used to compare projects. So you can, if you have competing projects which are there, should I invest in project A? Should I invest in project B? You can use this, get the profitability indexes, and then it will be easy to compare. So I have 1.08 in one place, 1.05 in another place. It's easier than comparing figures. So that's it. Then we came to the payback method. Number of years required to recover the original cash outlay invested in the project. So this was one. So let's say that in this example, suppose the cash inflow expected is 12,500 per year. Initial investment is 50,000 and the payback period is 4 years. See, the problem with this method is that it is not using the concept of present value. So the values which you are comparing are actually different. Negatives is there. Time value is not considered. This was one of the main problems here. So this is what we had done with regard to financial management. So we had understood compounding, discounting, future value, present value. We had looked at yield, price relationships. We also looked at how projects can be evaluated. We looked at these different ways of calculating return. So hopefully with that, you have a basic idea about some of the basic principles in finance. It is a very, very, what shall I say, a sketchy sort of an outline of a subject which has huge depth. But at least it gives you an idea about some of the basics which are there. And I hope that what we discussed today, if I ask questions about some of these concepts in, let's say, when we have that one-to-one interaction, you will be able to give me satisfactory answers. That is my main hope. So revise these on your own, begin revising it. Now we come to insurance. Now, once again, in insurance and in financial planning, there is nothing here which you will not understand on your own. You will understand all this perfectly well. All I am trying to do is, since you are sitting here and we are actually just trying to revise, all I'm trying to do is just remind you that these are some of the things that we had covered during this period. First of all, remember that insurance was a part of the financial planning. That whole section on financial planning and wealth management that we did, this is part of that, because for financial planning, one very big part of that is insurance. Why do we have insurance? Because we basically want to protect our dependents in the future. In the case of life insurance, in the case of property insurance, we want to basically reduce the amount of liability that we will actually have. So what are the things in the insurance? It's an agreement. There is a consideration which has to be paid, which is called premium. And in return for this, the insurer agrees to pay you a certain amount if a covered event occurs during the policy term. So these words in red are basically the main things, the words to remember. The two parties are the insured and the insurer. Then we spoke about fundamental risks. Losses that are impersonal in origin, they are group risks caused by economic, social, political phenomena. Let's say the war in Ukraine today, this is something which nobody actually has any control over. It's hitting society as a whole. So for this, you expect basically the government to deal with it. This was the thing. So Ukrainian citizens, they are going to rely on their government to come out with some sort of a solution to this. Particular risks, they occur due to individual events. They are felt by an individual. If an individual's house catches fire, there is a risk of fire, his house catches fire. That is the sort of risk which can be insured. This risk is something which cannot be insured at. Even though there are some insurance policies for war, for example. But the premiums will be very high. There is a problem out here. Then insurance cover is available for these risks and they are dealt with at the level of the individual. So basically this fundamental part, whole of society is affected. Which is the proper body to deal with it? It's the government. In the case of particular risks, it is basically cover is available. Individuals can insure themselves. Then we also spoke about the concept of speculative risk, where there is a possibility of loss, but there is also the possibility of gain. So you can't have insurance here. So you can't say that you insure my loss, if I gain something, I'll keep it in my pocket. That does not happen. So the entrepreneur faces a speculative risk in the quest for profit. The gambler has a speculative risk. This cannot be insured. So that was the thing which we are saying. Pure risk, there are only two possibilities, loss or no loss. There is no gain. So all the risks that we are concerned with in insurance are pure risks. These can be.
Sir,
yes.
Is the share market is also speculative risk?
It's a speculative risk. So you can't insure. So when you buy a share, you can't go to an insurance company and that is not possible. Anyway, so good one, Pareshji. So then we also looked at different risk management techniques. So we said that there can be risk avoidance. So don't do whatever that risky thing which is there, don't do it at all. Driving is risky. If I drive, I need insurance, so I don't drive at all. Avoid the risk. Risk reduction. So you can take steps which will minimize the loss. For example, having a fire extinguisher at home can reduce the loss due to a fire. Or you can assume the risk. That means I am prepared to pay for any loss that may occur. Instead of paying the premium, I will. So many of us do it with our health. So when health is good, we feel that health is so good. Okay, if I have to go to a hospital, I will pay on my own. I will not go for a health insurance. This is assuming risk. And risk shifting or transfer. This is that part where we say that no, we will shift the risk to an insurance company. We will pay the premium to the insurance company, but the insurance company is going to pay the amount of loss which we feel can happen. So this basically what happens is it insulates the individual from a loss which is there. So the premium that you pay is the cost of reducing your risk. So remember, from an insurer's perspective, if you're looking at this from the perspective of an insurer, risk is a condition in which there is a possibility of an adverse deviation from a desired outcome. Something is happening. If the outcome is adverse, then I have a risk. Now, for example, if I am insuring houses against fire, I expect that out of every house, one house is going to catch fire. from the point of view of the insurance company, the risk is something more than one. Because the premium that they will set is based on the loss of 1 per 100 houses. If more than that begins to happen, they will still have to pay. And if they have not considered it in calculating their premium, they are going to have a problem. Who does this calculation? Actuaries are the persons who actually predict. Okay. And if the actuary does it well, then of course, the insurance company makes a profit. We should always, how do we plan for an insurance program? So you have to set goals. Consider the goals of an individual, couple, family, single parents, unrelated adults living together. So income, age, lifestyle, financial responsibilities all have an impact on your insurance goals. That means how much insurance do you actually want? The basic thing to remember is you want as much insurance as is required to protect your standard of living. That is the whole purpose of insurance, in the case of life insurance. So in the case of liability insurance, of course, that is different. If there is, for any action taken by you, if somebody else suffers, then that other person has to be compensated. That is why we have the concept of third-party insurance let's say, in auto insurance. And we have personal liability insurance in different situations. So you can look at some of these slides again. This was another something that we have covered. Should I insure or should I not insure? So basically there was 3 concepts here. The large loss principle. Here insurance is essential. So if the amount of loss that can happen is very high, then I think you should insure. Let's say you are taking all your household goods, you are putting it on a truck and transporting these goods from one part of the country to another. Now, it is a huge loss that you will incur if that truck meets with an accident or if something happens. So it is good to take transit insurance in this case. In other cases, there can be a position where you may say that the loss is not going to be very large, so I will not get insurance. I will assume this risk. So it can happen like that. I have a very old car and I am not interested in burglary insurance. Third-party insurance is something which is mandatory. So I say that, okay, I will assume the risk of a loss due to burglary or a loss due to any other problems. I will only take third party. So if I only take third party, what have I done? I have reduced my premium substantially, but I have also assumed risk for other causes of loss. And then if there are some very minor, things which can happen, let's say that I have a small, think of it like this, I have a small mobile phone, cost of the mobile phone is only 10,000 rupees. And I feel that insuring it is unnecessary because if at all something happens to the mobile phone, I can always replace it with another 10,000 rupees. There is no serious loss that I am facing. Then we spoke about this concept, the term life insurance policy for a fixed term related to the working life of an individual. It provides a death benefit only. Remember, this was the big thing. If the insured dies, dependents will receive the insured amount. If the insured survives, no benefits are paid. Why should I take such a policy? Because the premiums are very low and it allows, it gives me a very large amount of cover for the amount of premium that I am paying. And in case of death, family members get a good payout and they are able to maintain their standards of living. So large cover can be bought for a low premium. In the case of an endowment policy, you have a death benefit also and you have a survival benefit. So that means it is for a fixed term. If you survive the term, you will get the amount of insurance policy plus the bonus. And in case of death, the dependents will receive the insured amount. The problem with this policy is that the premiums tend to be very, very high. When you compare with this, I think it is probably 10 times high in most cases. So this actually does not provide too much protection, but insurance agents have been pushing this policy forever, in fact. As far back as I can recall, this is the policy which they have always tried to sell because they get higher commission. Just remember that. When somebody tries to sell something to you, you should always ask yourself the question, what is this person getting? So nobody wants to sell you a term life policy because the commissions there are very low. I gave you this example here of an endowment policy. This was taken from an advertisement taken out by ICICI Prudential, where they were trying to market it like this: invest for 5, 7, or 10 years, get a guaranteed flow of income in the later years. So they're trying to pitch this as a pension scheme. And what are they basically trying to say here? So it's saying that a 30-year-old male can get a policy with a death benefit of 9 lakhs. And he pays a premium of 14,000 per month. So that means he's paying close to 1.7 lakhs per year. And what is the amount of cover that the person is getting? Only 9. How is the insurance company trying to make this attractive to you? It is saying that you pay me this for 10 years, and then we will pay you after 12th year, you will receive, sorry, I made a mistake there. The premium that you pay is 7,500 per month. Pay 7,500 per month, and after that, after 10 years, you are going to get 14,247 per month for the next 10 years. The return is guaranteed, tax-free and all. What you should always try to think of here is, what is your opportunity cost? Suppose you don't do this. Suppose you take that 7,500 rupees and you buy, let's say, with that money, you buy a term insurance policy, and part of the premium that you are paying to them, 7,500 multiplied by 12, so that is 90,000. The 90,000 that you are paying, out of that, if you pay even 10 or 20,000 for term life insurance per year, 10,000, 15,000 probably will do it for you for a 30-year-old. What is the huge amount of insurance cover that you will get? It will be in crores as compared with this 9 lakh. And the difference between the premium that you paid and this 90,000, if you take that money and you invest it, let's say in long-term equity, after 10 years, you will get a much, much better return than this 14,247. So when you think about these things, think of the opportunity cost involved. People will try to sell you all sorts of things. Then the other thing that we spoke about was the concept of human life value. And we said that there can be different methods of calculating this. And so there was the easy method. So this was like a thumb rule. Normal family will need 70% of the salary earned by the insured for 7 years after the death of the insured. So it is trying to arrive at a certain amount through this rule. It may or may not be actually suitable to you personally. For example, gross pay multiplied by 70% multiplied by 7. So if the gross pay is 3 lakhs per year, then the amount of insurance is only 14 lakh 70,000. You need to ask yourself the question that why are you taking this insurance? You are taking it because this is the value of your life. In case you are not there, what will the dependents get? So if you feel that this amount is correct, then you can go with this policy. Otherwise, it is always better to go for the better method that I showed you. So these are some other methods, the double income no kids method here, the non-working spouse method, the family need method. Probably the family need method is the one which takes into account everything. I had shown you how to calculate this in Excel. Suppose an individual calculates that his family needs rupees 10 lakh per year for expenses. Right now, he's providing this through his job. And he has 20 years more of his job. So after that, he will provide for his family from his savings. He will accumulate by then. The risk for him is if he dies within his working life, up to 20 years, what is the amount of term insurance he needs to support his family? So what are we doing here? The amount required for every year for expenses is 10 lakhs. This is my annuity that I want. Now, naturally, the amount that you will get, that amount will be invested. There will be a certain rate of interest. So I'll use this rate, let's say I assume it at 6%. So this is one. And if I now, and I take the number of periods as 20. So what is the amount of money that I require that which I can, what is the amount of insurance that I need? If I take this annuity formula, I get this 1,14,000. What is it telling me? If I get an insurance of 1,14,000, 1 crore 14 lakhs, sorry, and if I take this money and invest it at 6%, it will give me an annuity of 10 lakh rupees for expenses for 20 years. So this is the best way to calculate the annuity. If I want to calculate it in terms of the equivalent of 10 lakhs per month or 83,333, then in that case, I can do the same calculation like this here. Number of periods only will increase. The rate of interest will be adjusted from 0.06 to 0.005, 6% divided by 12. And I can then calculate, I get a present value of 1,16,000. This invested at 6% per year will give a monthly return of 83,333. So these are practical, what shall I say, practical exercises that can help you. So those of you who are beginning, those of you who are in the middle of your careers, for all of you, this is something that is going to help you in understanding how this actually works. So once I have that amount, I will add the special expenses, things which are beyond that 10 lakhs. What are those? Education of the child, marriage of the child, maybe there is housing loan debt. So I add all that. Now I have my present value of 1 crore 71 lakhs. So when I go to my insurance company, I tell them that I want a term life insurance. What is the amount of insurance that I'm looking for? I'm looking for 1 crore 71 lakh 71,000. So this was another, in my opinion, a very, very useful part of what we did. In this same section, you will also find something very interesting about EMIs. Go back there and look at that. Final calculation, we also reduced the savings and other insurance that we have. So assuming these two factors are also there, you can reduce the insurance required by that. So that was that. So that more or less covers what I wanted to do today. See, my original plan was to cover the entire course in 2 days, but we lost yesterday. So I wasn't able to actually take that. Otherwise, my plan was to go ahead with this, also take you through mutual funds and equities and that entire section, so that it would be easier for us to revise the whole course. Now, that is something which we have not been able to do, but I think it will be very, very possible for you to look at the slides that I sent you and cover that. So I think this brings us to the end of our lectures as such. Next week and the 2 days in the Saturday, Sunday that are coming up, what we will basically focus on will be the tests, the evaluations that we have. If we are still left with time, I'll be open to revising anything that you want on the last day, that is next Sunday. Okay, so I hope that was helpful for all of you, what we did today. And can we end it here now?
Yes, sir. One thing that we should share our mail IDs on WhatsApp group right now.
Please do that. Everyone, please share your email ID so that I can send you the assignments personally. So basically, when you get the assignment, you can call me, we can discuss it also. It's not a problem. But for the moment, I'll not disclose exactly what I'm giving. Send me your email ID so I can send it to you.
Sir, I have a question. Would it be possible for you to have a quiz instead of question and answer session on Sunday?
A quiz?
Instead of question and answer session.
Okay, I'll consider. Let me see.
Okay.
Let me see. Okay. Okay, then. Good night, everyone. Thank you so much. I hope this has all been very helpful for you.
Yes, sir. Thank you.